5 Best Short-Term Investments You Should Try. Most people cannot afford to live comfortably in the future without investing. As the coronavirus pandemic showed, a seemingly stable economy can be thrown on its head, leaving individuals who weren't prepared for rough times scrambling for revenue. Nonetheless, with the economy struggling through excessive inflation, what are the best investments for this year's investors to make? One strategy is to combine lower-risk investments with others that promise bigger returns. So let's see the 5 best short-term investment plans and ask you to try them. Number 5. Short-term certificates of deposit. CDs, or certificates of deposit, are financial instruments issued by banks that often carry a greater interest rate than regular savings accounts. When rates are expected to increase, a short-term CD may be preferable because it can be reinvested at a higher rate once it matures. These time deposits are backed by the federal government and have set expiration dates. Which can be anywhere from a few weeks to a few years. Because of the nature of these time deposits, they cannot be withdrawn before a certain date without incurring a fee. A certificate of deposit, or CD, allows you to earn interest from a bank at set intervals. At the end of the term, you will get your initial investment plus any income earned. To get the best deals, consumers should look around online. CDs are a viable option for retirees who don't require access to their funds immediately. And are willing to lock them up for some time because of their security and greater payments. Number 4. Rental housing. The ability and inclination to manage one's own rental properties can be a lucrative financial strategy. And despite mortgage rates going up, now could be a good moment to finance the acquisition of a new property, even if the shaky economy could make it more challenging to run it. Taking this option entails making several decisions about which property to invest in, how to pay for it, whether through a loan or cash, how to keep it in good repair, and how to interact with renters. If you shop wisely, you can do quite well for yourself. Nonetheless, you won't be able to trade stocks with the ease of a few taps or clicks on your smartphone or tablet. The worst-case scenario is getting a call about a burst pipe at 3 a.m. On the contrary, if you can hang on to your assets for a long time, steadily reduce your debt, and increase your rent, you will likely have a substantial cash flow when you retire. Number 3. Dividend stock funds. When you invest in dividend-paying stocks, you can feel a bit more secure about your portfolio overall. Dividends are distributions made from a company's earnings to its shareholders, often once every 3 months. If you invest in a dividend stock, you'll get a return on your money both in the long and short terms. Intermediate and advanced investors are better suited to buying individual equities, whether or not they pay dividends. However, you can spread your bets by purchasing a collection of stocks through a mutual fund. Although dividend stock funds may be preferable for income seekers, they are a solid option for any type of stock investor. Income seekers with the ability to hold investments for longer periods of time may find these appealing. If you're enjoying this video so far, please hit the like button and subscribe to our channel if you haven't yet to show us your support. Now let's continue. Number 2. Short-term corporate bonds. Investment-grade corporate bonds are debt instruments issued by large enterprises. They're reliable because they regularly disperse interest, often every quarter or every 6 months. A wide range of firms issues the bonds held by bond funds, and bond funds are pools of these bonds. With such a diversified portfolio, and single bonds' bad performance would have a much smaller impact on the entire return than it would have otherwise. Interest from the bond fund will be distributed regularly. Because of the high liquidity of short-term corporate bond funds, investors can buy and sell shares on any day the markets are open. Number 1. High-yield savings accounts. Instead of keeping money in a checking account, which normally offers relatively little interest on your deposit, you should consider opening a high-yield savings account at a bank or credit union. When you open a savings account with the bank, you'll receive interest payments regularly. High-yield savings accounts are a good choice for savers because it's simple to find out which banks offer the best interest rates and open one. You can contribute money to a savings account anytime, and the money in the account is easily accessible. However, most savings accounts limit customers to no more than 6 withdrawals or transfer per statement cycle. You should be wary of financial institutions that tack on fees for things like account maintenance and ATM withdrawals to keep your costs to a minimum. Well, that's all for today's video. Tell us in the comment section how this video was. I hope that you found this one interesting. If you want to see more videos like this, please consider subscribing for more. And don't forget to give comments and provide us with your valuable feedback. We'll see you in the next video with some more interesting facts and stories. And until then, stay tuned.